Hi guys, welcome to the channel. I'm Santi and this is going to be a super beginner friendly video on how to get started investing. Now, I know that this topic can be a bit intimidating at the beginning, so my goal with this video is to simplify the concepts that you need to know to get started. By the end of the video, you'll know what the stock market is and how you can make money from it and what kind of investments you can make other than individual stocks. So let's get into it. So what is the stock market? Okay, so to put it simply, it's the place to buy and sell stocks. And so the question then becomes, okay, so what are stocks? And again, to put it simply, stocks represent part ownership of a company. So let me give you an example. Let's imagine that I own a coffee shop, and after years of hard work, my coffee shop company is starting to do really well, and so I want to expand and grow my business. Now, to do this, I first need to rent another place, which means I need to buy more coffee machines, I need more supplies, I need to hire more people, and so basically I need more money to be able to grow my business. Now, there are two ways I can get more money to be able to do this. The first one would be through a business bank loan. Now, the issue with asking for a loan is that I eventually have to pay it back with interest. So if they give me, let's say $100,000, I might end up having to pay back $120,000 or $110,000, depending on the interest that the bank gives me on the loan. So getting a loan will actually end up costing me a lot of money. Another way to get the money is by me going to the public and announcing an IPO. An IPO is an initial public offering. It's me, a private company, going to the world and saying, I'm going to take my company public. Now, what this means is that I'm going to take my coffee shop, I'm going to break it into 100 pieces or 100 shares, and I'm going to distribute those shares to anyone interested in owning a portion of my business. And so I will set up a date, let's say Monday next week, and I will sell each share of my company for $10. So that's what an IPO is. It's a way to raise money from investors. So all the money that I get from people buying those shares on that day goes into my business. So in 2010, for example, Tesla needed money to expand its production, so they decided to go public. They broke the company into millions of pieces and they were able to raise $226 million in just one day. Now, whenever a company creates and sells stock, they are essentially selling a part ownership of the company, and they do this to raise money without having to actually borrow it. So going back to my coffee shop company, let's say you as an individual, you really like my company. You've seen my accounts, you see how much money I make, you know my product, which is coffee and great service, and you believe that my coffee shop company is going to continue to grow and expand in the future. So you decide to buy a small piece of the company, that is one share, for $10, and in exchange I give you an ownership in the company. Now, once you own this share, you as the buyer can trade it however you want. You can sell it to someone else, you can hold on to it for years, or you can buy even more shares. Now, your investment helps my business grow, and as the coffee shop company becomes more and more successful, more people starts to become interested in it and want to buy stocks in the company too. And so it becomes an issue of supply and demand. The more people are interested in buying my stock, the higher the price of the shares goes, and so the value of those shares that you already own also increases. So if you wanted to, you could now sell your shares to someone else for even more than what you bought them from, and this way you can make a profit. However, if for whatever reason my coffee company starts to become less profitable, then the reverse can happen. Say there is a lot of competition coming around and less people are coming to my coffee shop, and it looks like the future isn't so bright anymore. So if you believe the price of the stock is going to go down, then you'd probably sell it quickly, hoping that you can still make a profit. But as the shares are sold, the demand goes down, and so does the value of each share. Now, at this point you might be wondering, okay, so what is the difference between stocks and shares? And even though a lot of people actually use those terms interchangeably, they are different things. So you can think of shares as slices of pizza. When a company goes public, it divides its ownership into many equal parts called shares. So if a company has 100 shares and you buy one of those shares, you basically own 1% of that company. Now, when it comes to stocks, you can think of the stock company as the whole pizza. So it's made up of all the slices or shares combined. So when you say you own stock in a company, what you really mean is that you own a portion of that business, but you're not being specific about how many shares you actually own. So to sum up, that buying and selling of stocks is what the stock market is. It is the place to buy and sell shares of companies, or in other words, it's the place to buy and sell part ownership of companies. And you usually do that through a broker, which is basically an intermediary between you and other buyers and sellers. Now, there are many kinds of different brokerage accounts today, and most of them allow you to buy and sell stocks from your smartphone from anywhere in the world. So it has become a very easy process over the years. All you need to do is set up an account with an online brokerage and start buying and selling. So how do you make money from stocks? Okay, there are two ways people can make money from the stock market. The first one is through capital gains. Now, this is very similar similar to capital gains on real estate. With a house, let's say you buy it and then 10 years later you decide that you want to sell it. The price most likely would have gone up. So if you bought a house for, let's say, $500,000 and then sold it for $750,000, then the capital gains or profit would be the difference between the price you bought it at and the price you sold it at, which would be $250,000. It's the exact same thing with stocks. When you buy a stock, it's because you believe it's going to be worth more in the future. So let's say you buy $1,000 worth of Amazon stock and then you wait a couple of years and now that same stock is now worth $1,500. Okay, you would have made $500 in capital gains. That's one way you can make money. Another way is through dividends, which is essentially a way in which some companies, not all but some, distribute a portion of their profits among their investors every quarter or every year at different times. And they do this as a kind of like a thank you to their shareholders for investing in their business. Now, some companies have been doing this for the last 20 to 30 years, so a lot of people actually choose to actively invest in stocks that pay dividends because they actively receive a passive income from that investment. It's worth noting though that companies don't have to give dividends, so they could be giving them for the last 20 years and then some black swan event hits and they decide to stop giving anything. That's why a lot of investors actually like to see dividend payments as a kind of like a cherry on top. So the idea would be to invest in growth companies that you believe will have a capital gain in the future, and then the dividend payments coming through would be just an added bonus. So even if the company stops giving dividends, you can still rely on the share price going up and getting the capital gains. So that leads us to what to invest in. So I wanted to share a quote from a Berkshire Hathaway shareholder letter from 2016. This is Warren Buffett's company, and it goes, "American business, and consequently a basket of stocks, is virtually certain to be worth far more in the years ahead. Innovation, productivity gain, entrepreneurial spirit, and an abundance of capital will see to that." Now, from this we can take two lessons. Number one, invest in a basket of stocks, otherwise known as index funds. And number two, do it for the long term. Now, when it comes to investing, we have stocks, we have mutual funds, index funds, ETFs, which I get could sound a bit too complicated at the beginning, so I'll make sure to break down each one of these concepts in future videos, so please let me know in the comments, guys, if you would be interested in that. Now, for the purpose of this video, let's just summarize index funds. Now, if you ever heard the term "don't put all your eggs in one basket," well, think of your money as the egg and a company stock as the basket. So say I wanted to buy Microsoft shares and only Microsoft shares. I'll be putting all my money in that basket. So if Microsoft ever did go badly, then all my eggs might get smashed. So an index fund is basically a group of companies, and they could all be grouped together based on their sector. So they could all be tech companies, or they could all be grouped together based on their size. So they could be the biggest companies within a country. An index fund is basically a way of buying all those companies within a group at once. So you can think of it like buying a basket full of baskets. Now, if you put all your money in all the baskets, then if Microsoft ever did go badly, it doesn't matter because Apple, which is in the same big basket, is doing well, so they kinda compensate each other. Again, going back to the house example, if you had $1 million to invest in real estate, you could buy one huge house worth $1 million. But a much better option would be to buy 10 smaller houses worth $100,000 each. Now, in reality, both investments would be worth the same and would probably appreciate at the same rate over the years. However, if the big house ever catches fire, then all of your investment is gone. Instead, if one of your 10 smaller houses ever catches fire, you still have 90% of your investment from the other 9 houses. And if a second house gets hit by a tornado, you still have 80%. So you see, it's not about which investment is more profitable, it's about which investment is less risky. And the exact same logic applies to the individual stocks versus index funds. Individual stocks being the big house, and index funds would be the multiple smaller houses. So there is loads of different kinds of index funds, and they all have fancy names like the S&P 500, which is basically just the 500 largest companies in the US. If you look through this list, you'll likely recognize most of these companies like Microsoft, Apple, and Google, and many others. By buying a piece of an index fund, you're essentially buying a little bit of all the companies that are in that fund, which is a great way to diversify your risk, and it gives you an easy way to investing in multiple stocks at once. So if you are a beginner looking at investing for the first time, then index funds would be a very solid place to start. In fact, I wanted to close with one final quote from Buffett, and it goes, "It's amazing how hard people make what is otherwise a simple game." So there you have it. Investing is actually a very simple game that for some reason is made to look way more complicated than it really is. So my goal with this channel is to make financial knowledge accessible and attractive, because it is. So anyway, that is my beginner pack on how to get started investing. Thank you guys so much for watching. Don't forget to subscribe, and I'll see you in the next video.